Hello and welcome to LBMA webinars. We at LBMA hope you're all doing well wherever you are in the world. Today's webinar is the last webinar before we break for the summer. So in light of this, we wanted to take a look at our most popular webinar in this series since it started. This webinar, Sustainable Finance, Risk and Policy, features Paul Fisher. Now, for those of you who don't know, Paul is a fellow at Cambridge University for Sustainable Leadership. He is also the board chairman for London Bullion Market Association. And the webinar also features Terry Heymann, who is the Chief Financial Officer at the World Gold Council. Also in this recording, you will get a special feature of Sakila Merza. She is the General Counsel and Executive Director of the board for LBMA. So she'll be heading in for some Q&A time that was recorded along with the webinar. Our panelists discussed what sustainability means and the importance of ESG and how this affects both the mining industry and the investment industry. So with the way that audience views are consistently rising from week to week, we know that a lot of people are interested in this topic and we can't blame them. It's a very important topic and it's a very great webinar. So without further ado, let's take a look.
This is a very interesting topic to me personally. It's something I've been working on now for 5 or 6 years. I just want to start by noting that I do not consider myself a green campaigner. By background, I'm an economist, central banker, ex-regulator, and the approach I take comes from that direction. It's true that climate change, sustainable finance is a moral, social, political, ethical issue. But actually that gets in the way, particularly in the financial sector, of dealing with it. And I come at this from the point of view that it's an economic issue, a material business risk and business opportunity for all firms, particularly financial firms. And that's why I would like businesses to try and focus on it. Put the social side of it, if you like, to one side to start with, and think of it as a business issue. And it's an area where it turns out that the public good and the private good are actually closely aligned, not at loggerheads. But somehow the campaigning can get in the way of that. So I'm going to be talking mostly about climate change because that is the major existential risk on sustainable finance. But the approach does cover some other aspects of the particularly United Nations Sustainable Development Goals as well. But this is the urgent priority. And I like to start just by showing this chart. Some people still don't quite believe in global warming. There's not really any scientific debate any longer about whether global warming is happening. This chart, which is taken from the UK's Met Office, clearly shows it is. The importance of this chart is that the reference point, the average temperature between 1850 and 1900, is taken as a starting point for all the calculations you will see about limiting global warming. That was the basis of the Paris Agreements in 2015. And you can find many such charts like this, just Google it on the internet, and they all show very similar pictures. Different sources have slightly different data, but they all look pretty much the same. They will all have 2016 pretty much as the warmest year on record, but some have 2019 as the second or third warmest, and it's third warmest on this particular data set. And just a few points about this chart. First of all, at first glance, it looks like there's a trend in global warming going back to the start of the century. But if you look closer, up until about 1980, there's almost no trend in global temperature. It really kicks off from about 1980. I don't have quite time to go into the details, but it coincides with industrialization, particularly in Asia, and the growth of carbon emissions from the Asian economies. It's very closely correlated and is the obvious explanation. So really, up until about 1980, you could have been forgiven for not thinking there was a significant global warming going on. The trend has only really become apparent since then. If you're situated in Australia, which I believe some of you are, the data just for Australia is much clearer, and you get a trend going back to 1900, surprisingly. A second thing about this chart is to note the volatility in temperature year to year. And that change in that year-to-year variation is actually much greater than the increment in the trend each year. And it's the volatility which matters in the near term, because the volatility in the temperature which generates the extreme weather events. And the number and severity of the extreme weather events goes up non-linearly with the average temperature. So over time, we're seeing more and more extreme weather events come through, and that's what people are witnessing. So it is the volatility, I think, which really matters in this debate, and it's the volatility which plays into the risks, of course. Now, just one more chart on the climate science. You can't really deny that global warming is happening. That's clear in the data. Some people still don't believe that it's man-made, although most of the scientific community have made their minds up on that. But it turns out that global warming is very closely correlated with carbon emissions. And this chart shows estimates of how much carbon is in the atmosphere, carbon dioxide, going back over 800,000 years. And you can see that very sharp spike at the end, which is basically the last 100 years. The last time that carbon dioxide concentrations were at this level, they think, is about the time of the extinction of the dinosaurs, when sea levels may have been 50 to 100 meters above what they currently are now. So we'll leave that aside and move swiftly on. But there's not much doubt now that global warming is being caused by greenhouse gas emissions, trapping heat, and having other effects on the planetary surface. So let's leave the climate science behind. And one of the main points of this short seminar is, even if you don't believe in global warming, even if you don't believe it's man-made, you're still going to face a lot of the risks because governments have decided that they're going to do something about global warming, and that generates risks for you as a business, particularly if you're in the financial sector. But we look at the risks in three lenses. The physical risks, this is what you would expect, storms, floods, droughts, wildfires that we've been seeing more of in the last few years. And that comes alongside the volatility in the temperature and the more extreme weather events that we're getting. And there's also some evidence that these weather events are getting more correlated across jurisdictions where previously they were not correlated. More interesting to me as a policy person is the transition risk. And this comes in two flavors, really. First of all, whether you believe in climate change or not, the demand for goods and services is going to suffer structural change as a result of global warming. Most obvious one is an increase in demand for air conditioning units, for example, in places like the UK. There's also going to be more demand for electric cars. I should come off that in a minute. And you can predict a number of other things resulting from just changes in demand preferences, changes in supply conditions, changing the economy. More interesting still is the risk from policy. Governments have decided to do something about climate change. 180 odd of the world's authorities said back in 2015 that they would try to limit global warming to no more than 2 degrees. And most countries and jurisdictions outside the United States are adopting policies to try to hit net zero carbon emissions by 2050. Now, until recently, we haven't known exactly what governments were going to do because the policies that existed in 2015 were not consistent with that 2 degrees target. As we find out what governments are prepared to do, those policies will undoubtedly affect businesses. They'll affect what you can and can't do, places where you can and can't make money, and some of them will cost you money because there will be new requirements. So you have those policy risks, regardless even of whether global warming exists, because governments are going to do something. The legal risks we won't say too much about, but people will get sued for either causing climate change or not doing something about it when they could have done and nailed responsibility, and that has already happened. So just briefly on the structural change side, some of this will be disruptive. And an example is driverless cars, which are already here. I've actually got one which could in principle be driverless. But it's a combination of different technologies coming together. Batteries, renewable energy, artificial intelligence, and the economics of the industry it's going to be very much cheaper to run and own an electric car than it is a fossil fuel car in future. We don't know which companies are going to make them. It might be Tesla, unlikely, maybe somebody else. One thing I can tell you is that driving an electric car is a whole better experience than driving a fossil fuel car. And that's another reason why eventually these will take over. There's a great academic based in the United States, Tony Sieber, who does some really good videos on how business disruptions work and how quickly they come through. And there is evidence that disruptions, technological disruptions to industry are happening faster and faster. This chart shows some impacts of how these sorts of changes can impact on the financial sector, on financial assets. I have two charts here of equity prices. On the left-hand side, you have one of the largest utility companies in the world, Pacific Gas and Electric, and what happened to their share price in the face of wildfires in California. These were very severe, caused in part by drier drought conditions in the forests, and Pacific Gas and Electric ended up in Chapter 11 because of in part because of the legal liabilities associated with the physical damage from those wildfires. So this is an example of how physical risks combined with legal risks kick in to essentially eliminate the value in PG&E. On the right-hand side, you have the shares of Peabody Energy, which was the world's largest privately owned coal producer and was based in the United States. It ended up in Chapter 11 in large part because of a change in US policy, where they moved in favor of gas and particularly fracking and away from coal. And that was a slower moving event, but eventually Peabody Energy lost its value. Now, I have actually sat opposite investors who had these stocks in their portfolios and essentially lost that investment. And it was 100% loss pretty much at that time. Now, on the basis of a sample of two, you might conclude from this, I've actually been looking for more evidence. The physical risks actually get you quicker than the policy risks on what we're seeing so far. The physical risks, although climate change appears to be a long-run phenomenon, these physical risks can kick in literally overnight and can destroy the value in companies overnight. Whereas the policy risks typically take a while to formulate the policy, takes people a while to work out what the impact of that policy is going to be. So although the policy risks can be sudden, they can also be a bit slower. But we have had these demonstrations of how the risks from climate change can impact on a portfolio of assets. Now, this next chart just shows some of the policy interventions happening in the financial sector. I limited it to things which I have at some point been involved in and tried to map a range of policy things through to the risks as we've just described them. And this is a busy chart, it doesn't really tell you very much. But what it does tell you is two things. One is there's a whole lot of things going on, and everywhere you look, from cities, states, G20 national governments, supranational regulators, prudential regulators, the EU, your investor base, your client base, everybody is throwing questions and pressures at firms, particularly in the financial sector. The other thing I tried to highlight here was the red and the green, where the red corresponds to people trying to stop you doing things, particularly with fossil fuels, and the green is where people are trying to encourage you to do something. And it turns out this is not a continuous spectrum of policy. You tend to get one group pursuing green policies and another trying to stop brown activities. And they tend to come from different sources. Governments in particular, who like to be positive, like to try and promote green finance, green activity, and they leave it to the regulators to try and stop the things they don't like because that's unpopular. Moving swiftly on, what are the financial regulators are saying? These are pretty much quotes taken from the Bank of England's papers, and they consider this to be a risk that is pervasive, far-reaching relative to other risks they look at. Although the precise nature of those risks is uncertain, it is foreseeable in nature, and the time horizon for the risk is a long one. This is not a sudden one-off event. And the extent of the risk depends on what policies are taken now to address it. By far the most expensive way of dealing with climate change will be to do nothing now and wait until the crisis kicks in, and then you have to do something. And that's a lesson we learned from the great financial crisis and indeed from the recent COVID crisis. That waiting too long and then taking action only when you have to means it's much more expensive to deal with. Unusually, there is now an international grouping of regulators who are sharing best practice on this topic. The last count had 66 different regulatory organizations as members. What are they doing? Again, I've based this largely on UK actions, but these actions are getting replicated in other jurisdictions. The PRA has issued supervisory expectations to its authorised firms about how climate change should be risk managed. In the UK, all financial firms are supposed to have an individual person at senior level accountable for managing the risks from climate change under the UK senior managers regime. For the large banks, that is, so far from what I can see, nearly always the chief risk officer. The Bank of England is preparing coordinated climate stress tests for next year. Some of the work on that has been slightly delayed by COVID, but I understand it's all still on track to be delivered. And there are new disclosure requirements. Up until now, these have been voluntary, but they are being written into the rulebook as we speak, both in the UK and in Europe. And those first 4 bullet points can all be summarised for those of you who know about the Basel regime as Pillar 2 and Pillar 3 interventions. And the Basel Committee has got a working group looking at the broader context, which I think will also cover Pillar 1, i.e. minimum capital requirements. So there's a lot of work going on in the regulatory sector, which has got authorised firms rather focused on this activity. More generally across industry, the biggest game in town over the last few years has been the Task Force on Climate-Related Financial Disclosures, set up by the G20 Financial Stability Board, because they are worried that the impact of climate change could lead to a sudden widespread fall in asset prices, which will create a financial stability risk. And one of the ways you can reduce that risk is to have better disclosure from firms across industry, which enables people to price the risks better in advance. And they recommend people disclose around their governance, their strategy, their risk management, their metrics, and their targets. And of those 4, the one that tends to be the weakest element is the strategy, which needs to be active. This isn't an agenda where it pays to wait and be told what to do. Being an active and trying to find out what your customers want is the key thing. Now, given the time limitations, I'm going to skip through to precious metals. We'll leave aside what's happening in Europe. How does all this apply to precious metals, which is why we're here today? Well, the good news is the top 3 points on this slide. Gold and other precious metals have properties that could make them an essential part of the technology that's needed. They can be recycled in large scale, which is great for the circular economy. And there are huge cost-saving opportunities. However you look at it, mining, refining, and logistics in particular all use large amounts of energy. And renewable energy is going to be a lot cheaper than fossil fuel energy going forward. It's already reaching the crossover point, and people are already saving money by switching. If firms don't switch, they risk being undercut by those who do and get the benefits. And so this will become a competitive issue. And then there are things which will bear down on the industry, which needs to manage its risks from physical transition and legal. All firms will eventually, I think, be required to demonstrate a path to zero carbon emissions. That will be voluntary to start with. And again, all firms will be required eventually to meet the TCFD recommendations on disclosure. And my message to the precious metals industry is that you could be seen as part of the solution, given the first bullet points on this slide. If you get lumped in with fossil fuel miners, for example, you could be seen as part of the problem. And so it's very important the industry puts a very positive message on here. And I will stop there just with the thought that this agenda is being implemented by governments. It's here now. The risks are not just long term. They can actually crystallize unexpectedly at any point. And these risks mean it's an agenda on which firms can either make money or lose money, depending on what action they take. So I'll stop there and hand over to Terry.
Great. Well, thank you very much to the LBMA. Thank you for the opportunity to speak about what the World Gold Council has been doing and hopefully my slides are now up on the screen. If that's not the case, then somebody can let me know. So, look, agree with everything that was said around the importance of the industry taking action on climate change, the recognition that this is a issue from a financial perspective and that it has financial implications. And the gold sector has been taking action, and it's important to continue that it takes action. One of the drivers that we're increasingly seeing from the investor community is understanding both, to the points that were discussed before, where and how the gold industry is taking action to reduce its emissions, but also critically, the way in which the changing environment will impact asset prices of gold and of companies in the gold industry, both, as just was discussed, around the physical and around the transition risks associated with it. All right. I'm going to try and move my slide forward, and I'm not sure that I'm seeing that. Apologies. Taylor, if you're there, maybe you can just move on to the next slide.
Yes, one moment.
So, okay, there we go. So we put out a report last year looking at gold and climate change, current and future impact, and really focused on 3 topics. Firstly, looking at the carbon footprint for the entire gold sector as it is today. Secondly, as has just been discussed, looking at what the net zero pathway can look like for the gold supply chain, with a particular focus on the mining side, and I'll talk to that. And then thirdly, and this speaks to the opportunity for the sector, the role that gold might play as a risk asset, as a climate risk asset, given the potential that there is significant asset repricing given climate change. So, looking at the carbon footprint, we undertook what we believe is the most thorough analysis to date across the entirety of the gold supply chain, upstream and downstream. And the key finding is really just how much of the emissions are associated with the mining and direct processing aspect of the gold supply chain. Approximately 99% is in the upstream part. Very little emissions are associated with downstream in terms of fabrication of jewelry and technology. And what that means is, firstly, it's a very different profile to many other commodities, and not just fossil fuels, but many other metals as well. And secondly, and critically, it's fairly straightforward to see where the opportunity is for decarbonisation. And to Paul's points, and I fully agree with them, there is a real opportunity here for decarbonisation. And the ability for this industry to decarbonise is an opportunity, in that I think it will attract investors, and it will demonstrate that this industry can be at the forefront of addressing issues, global issues and challenges associated with carbon. If we look at the net zero pathway for the sector, and again, this is setting out what we believe is possible. It is not a forecast per se, but we think it is absolutely realistic that the gold sector as a whole, again, given the particular focus on gold mining, given the emissions associated, can get to net zero by 2050. And that is in line with the Paris Accord and the commitment to keep emissions well below 3 degrees and ideally significantly below that. How can that happen? Well, I think it's going to become an economic driver. as was mentioned earlier, renewables are becoming increasingly cost competitive, and storage solutions are also becoming efficient from a cost perspective as well as a energy usage perspective. So the tables on the right of this slide look at the decrease in costs over the last few years, and if you forecast that out over the next few years, you can see there's going to be an ever more compelling case to change energy sources from a financial perspective. That, I think, is very positive. It means that there's a real commercial driver, in addition, obviously, to the driver around reducing carbon emissions. But then there are other reasons as well, and in particular, in the mining sector, there's been a big push around reducing diesel usage, and that is obviously around carbon emissions, but it is also because diesel can be a challenge to manage on site, particularly when used underground. It can have health implications in terms of the particulates, and so you're seeing lots of movement away from diesel for a few different reasons. And just to look briefly at some of the examples of what our members do, for those of you who don't know the World Gold Council, we're a membership association representing 26 of the world's leading gold mining companies. We're already seeing significant action on this move towards renewables and on the move towards increased energy efficiency. And I've just highlighted a couple of examples here. There are lots more. The world's first all-electric mine is a gold mine. It's the Borden mine. It's a Newmont mine in Northern Ontario. All the fleet are electric, and in large part that is, again, because of this desire to move away from diesel. We're seeing the installation of huge solar arrays in many parts of the world, and if you think about the gold mining sector and where gold mines are often found, they're often found far from the grid, far from other big communities, and they need to create and develop their own sources of energy. Historically, that's meant trucking in diesel or heavy fuel oil. Increasingly, companies are looking to take advantage of renewables because those are available. And IAMGOLD's Essakane mine in Mali is a great example, and there are others in West Africa and beyond where the conditions are really pretty perfect for using renewables. Use of hydropower, many mines around the world use hydropower and are looking to figure out how they can increase. And then I think it's important just to talk about energy efficiency. And we all think about energy efficiency, or we should all think about energy efficiency. Mines are no different, and there are many initiatives that are ongoing just to take another look at the way mines operate and increase energy efficiency. Moving on, I want to talk briefly about the role that gold might play as a climate risk mitigating asset. And we've done some very initial analysis that speaks to and looks at the role that gold might play in portfolios, given that there is the potential that there will be significant asset repricing. And given that gold is well understood as a risk mitigating asset, and given that gold has a diverse set of demand drivers, and given that once gold is processed and in the form of an investment, there are very, very low incremental emissions associated with that. All of that points to the fact that gold is likely to perform better than most mainstream asset classes under a range of different climate scenarios. And there's more on this on the report, and happy to take questions later. And then finally, again, just touching on something that Paul briefly mentioned, gold actually can be part of the solution as the product as well. And particularly in nanoparticulate form, there are some really interesting applications that are both being used today, and indeed applications that are being developed for the future, where gold's role, particularly as a catalyst, again at tiny scale, nanoparticular, can help provide some of the tools that will support us through the energy transition, be it converting CO2 into usable fuels, supporting the effective and efficient operation of hydrogen fuel cells, and there's a lot of work going on around hydrogen fuel cells, or indeed in photovoltaics, and that's already a well-established application for gold. Now, none of this is going to change meaningfully the demand for gold, but important in terms of what the metal can do as we look for new technologies. And then finally, just broadening out the conversation a little bit beyond climate change, wanted to take the opportunity to look at the responsible gold mining principles, which is an overarching ESG framework that really defines those material aspects that relate to responsible gold mining. This is a set of principles that we at the World Gold Council worked on with our members, and very wide input from a range of stakeholders, and set out last year. The leading gold mining companies of the world, our members and others, are implementing this now. And it really does speak to, if you conform with the responsible gold mining principles, you should be recognized as a responsible gold miner. Conformance requires public disclosure, independent assurance on that disclosure, and it is a very clear statement of the commitment that the world's leading gold mining companies have to operating responsibly and to communicating clearly, accessibly, and in a way that promotes confidence through an external assurance process that they are partners and committed to sustainability for their own operations and the global gold industry. So with that, let me pause. Both of those information on both the Gold and Climate Change Report and Responsible Gold Mining Principles is available on our website, and I will hand it back, and I think we're going to go to questions.
Great, thank you so much, both to Paul and Terry. Very insightful information. I mean, the WGC report, certainly very interesting, and in terms of some of the findings you've shared with us has certainly been helpful. And Paul, you know, I think I'm probably speaking for a lot of us, by starting the presentation in very much clearly clarifying that you're not a green activist here. It is looking at the business perspective and the business opportunity of sustainable finance, and absolutely resonated with me at least, and with several others, no doubt. So this is not just about the social, moral, political, but actually there is also a business opportunity that could drive some of the developments forward. So thank you to you both for sharing your insights. Just a few questions. I'm also conscious of time. So this one, I mean, perhaps for you both, but I'll start with Paul Fisher. This is around the ESG rating agencies. There's a lot of rating agencies out there. In fact, I just did an initial quick Google based on this question. There's over 100 rating agencies. How useful are they, and are they actually needed? A lot of investors do place some emphasis. What's your view on these rating agencies?
Well, rating agencies play a role for people who are not able to do their own assessments and their own ratings for people. Now, there is an argument that says if you can't yourself assess a risk, you shouldn't be trying to take it. And most of the best investment houses in the world will do their own assessments and they'll use their own ratings. And when I was at the Bank of England, we would never have relied solely on external rating agencies. We always did our own analysis. But they do have a role to play. They help put pressure on the industry. I think that they are a commercial service. You either use them or you don't. You have to be careful. Most of the time, significant downgrades happen after the asset has lost its value rather than before. So I think they are part of the setup. They play a role. I don't think you can safely rely on them to tell you what the risks are.
And Terry, did you have a comment?
Sure, if I may just add to that. Look, especially on the ESG front, I think it's a relatively new field of ratings agencies trying to understand how they provide metrics from an ESG perspective. I heard it described quite well at a conference recently, well, not that recently, but we've sort of seen in credit markets development of ratings agencies over 30 years to get convergence in ratings, different ratings agencies having methodologies that broadly give similar alignment. We're not seeing that at the moment on the ESG ratings agencies. We're seeing very different approaches, different emphases of what's important by the rating agencies or by the industries that they're looking at and how they think about that. And I think it's, as Paul says, an important service and one that is that the investors are increasingly paying attention to, but it's still a relatively immature process in terms of the ESG ratings agencies. It's been interesting, even just very recently, seeing Jay Clayton, the chair of the SEC, speak about some of his concerns that they're trying to create a single number that gives an output across all ESG metrics, and is that feasible? Absolutely right that investors are paying increased attention. I think there's an increasing role for, if you like, industry-focused indicators that really speak to the material issues for that particular industry, and that very much is what we try to do with the Responsible Gold Mining Principles.
I could just add to keep up. There's a lot of evidence now that ESG investing actually generates higher returns than other forms of investing, and nearly always it's the governance indicators which seem to be one of the major sources of information. If I had to pick anything, I would try and look for ratings which looked in particular at the governance. Companies which have good governance tend to take a longer term view. They tend to worry more about some of these risks that might get ignored by firms with less good governance.
Okay, so on to the next question, and this one perhaps for Paul, and then the third question for Terry. So the question is the climate risk of client portfolios the client's responsibility, or should the banks be absorbing some of that responsibility? So that's for you, Paul.
Well, it's not so much the banks as the asset managers.
I can't hear you, Paul. I don't.
So it's not so much the banks as the asset managers. But banks don't manage other people's money. When you put money in a bank, you lend it your money, and it's theirs to do what they want with. So it's a shared responsibility. Ultimately, it is the client who has to decide what to do with their money. But they have to be informed, and they have to have investment opportunities available to them. This is why on the high-level experts group at the European Commission, we said that financial advisors should be required to ask their clients about their sustainability preferences. Because what was happening was the IFAs didn't know anything about sustainable investing, they weren't offering it as a service, and they were ignoring the question. Once you ask a client about their preferences and you know what their preferences are, you then have to offer investments which are suitable for the client. And so there is a dual responsibility here. It wasn't being taken up by the financial advisors in terms of advising our clients on what the options were or what was available. And so we have changed the rules in Europe to make that a requirement.
Thank you, Paul. The next one for Terry. The question is, who would you say is ahead in quantifying CO2 emissions and reducing them? Would you say it's the mining or the jewelry industry?
Look, I think candidly the mining industry has paid more attention to this, not least because of investor expectations on mining companies, and ESG has been a long-standing topic of discussion around what mining companies are doing to address the sustainability agenda. And I agree with Paul's point. If you think about running a business for the long term, you have to think about how you manage it effectively for the long term, and that speaks to ESG considerations. So ESG, the nomenclature might be new, but the idea about managing for the long term and therefore thinking about how you manage environmental and social aspects over the long term and put the right governance in place is deeply embedded in mining companies that have a 30 to 40 year lifespan from development to closure for an individual mine. So yes, mining companies put a lot of effort into the overall sustainability agenda. I think climate is increasingly raised up where it's sat in importance. And there are certain jewelry companies that have got involved and are engaged, but it would be great to see more.
Great, thank you. It's almost impossible to have a webinar these days without actually mentioning the current environment that we're in, partly why we have so many webinars these days. COVID-19, again, maybe open to you both. There's certainly been an impact with the fall in CO2 emissions in some cases. How do you think COVID-19, or at least the lessons we're learning from COVID-19, or at least the impact, may shape or influence government policies in the future? Would governments go back and rethink those policies? Or do you think that it's just helping them sort of cement what they already have in place? And perhaps starting with Paul on that one.
Yeah, there's three ways of which I think this works. First of all, COVID-19 is accelerating some trends which were already present in the economy. towards home working, towards less business travel and more video conferencing and so on. And firms, for example, which were already marginal, will end up going bust almost certainly, unfortunately. Secondly, there's a whole question around whether this presents an opportunity to, what they say, build back better. Don't waste a good crisis. Governments are having to put a lot of money in to support the economy. They could direct that money in such a way as to help meet their other agendas, of which decarbonisation is one. That is a big discussion that's going on around the world. The IMF has even waved in on it. We'll see what happens. The third one is the one that interests me most and also most worries and gives me the greatest hope, which is what we really learned from COVID-19 is people didn't really want to believe it was going to happen. They didn't really want to believe the worst. They didn't want to believe that we were going to go into lockdown on that tens of thousands of people would die. So in consequence, action was generally late, generally not as effective as it would have been had it been done earlier. And the consequences were both inordinately more expensive and sadly deadly than they might have been if people hadn't been so optimistic at the outset about what the consequences were. And this is the second time in a short period we have learnt this. We learnt it about the great financial crisis as well. People didn't want to believe there was going to be a big financial crisis, didn't want to believe it was going to have the sort of effects it did. The action, therefore, to ameliorate it was much, much more expensive as a result of that. And the question is, are we going to learn this lesson with climate? Are people going to not want to believe that climate is going to have these effects, not want to believe that we need to take action and not put in place the necessary measures, in which case we trip into it at some point in the future? Do we wait for London to flood before we rebuild the Thames Barrier? Is the way I always think it. Surely that's the most expensive way of dealing with it. Or do we look at history and say, yeah, when you've got these very large, significant existential risks with a reasonably high degree of probability, you need to take action and you take action early. And that could go either way. But I do worry slightly about the optimism bias that's just inherent in human beings.
Yeah, I would agree with that. And look, I think from an investor perspective and from financial markets perspective, how you actively think about pricing that risk in today, and certainly in terms of directing capital, engaging with management to understand what companies are doing across the precious metals industry to respond not just to climate change, important as climate change is, but across the ESG agenda. And that certainly is an opportunity. We're seeing more investors wanting to understand what the long-term ESG agenda looks like because they realize it has real commercial implications. And I think that is just going to be exacerbated by COVID, and hopefully push investors to become longer-term thinkers as well. There's a real opportunity for investors to help change the dynamics, and perhaps to Paul's point, optimism is great, but also balanced with realism and looking out for the long term. And if we can, as a system, think about the long term and how to manage and organize things for the long term, including allocating capital, then that gives me hope that we've learned something from this crisis.
Great, well, thank you for that. Unfortunately, we have gone a little bit over, so thank you to all our attendees who've stuck it out until the end. So thank you. We did have a few more questions. I do apologize because of time. I can't continue with those questions, but we will try and follow up with them after the webinar. So again, thank you to the attendees for dialing in, and of course to Paul and Terry for your invaluable opinions. Thank you.
Thanks, Sakira. Thank you, everybody.
Good day, everybody.
What a great webinar, and what a great pair of gentlemen to talk about sustainable finance. It really is great to kind of see more about ESG, and we've done quite a few webinars around ESG, responsible sourcing and sustainability. And you know, for those of you who do follow the series, we did a webinar 2 weeks ago, Responsible Gold Guidance version 9. So if you do want to have a look at that, it is available on our website. We also have a document which details all the changes if you do want to read more about that. But it's just really nice to kind of see how everything links in across the supply chain, from, you know, sustainability in the mining industry all the way up to investment. And we've seen that in quite a few webinars, even in digital gold, and how kind of as digital gold rises, how that does impact ESG and responsible sourcing. And so do take a look at the other webinars. This will be linked to a few other webinars at the bottom of the page. So I hope you're watching that directly from our website, our lovely, lovely website. So thank you very much to Shelley Ford and Jamila Lee for working tirelessly to make that perfect. That's all we have for you today. If you do have any questions at all about what you did see in this webinar or anything, do email us at ask@lbma.org.uk. We'll be happy to kind of forward these on to anybody. It could be about something you've seen in this webinar. It could be about ESG, responsible sourcing, or responsible gold guidance in general. Please do email them through to us. We want to hear your opinion, or even if you just want to say well done, we'll happily accept those as well. Moving forward, we've got some exciting news. We have some new dates for the LBMA virtual training. So we have Introduction to Loco London in September on the 15th and the 16th. So that is split over 2 days and will take place in the afternoon between 2 o'clock and 5 o'clock at BST. So if you are in a different time zone, perhaps in America, and you do want to attend that would be a really great one to get along to. Not on the screen, but we have just released dates in December, so December 2nd and 3rd. So that will follow the regular structure. On the 2nd, it's an introduction to Loco London. And on the 3rd, it will be how to use Loco London. So if you do want to do those 2 courses in bulk, I definitely recommend that. If you are a member, that does fall immediately after our annual dinner, which is not on the screen, but just make sure you're aware of that and the early morning 9 a.m. start that you will find. Some very exciting news. Today, we have launched the LBMA LPPM Global Precious Metals Conference, which this year is going to be run virtually. So you can see the dates on the screen. It won't let me fit 21st in that bubble, but it runs the 20th to the 21st. We have 2 half days, so Monday afternoon and then Tuesday morning to kind of accommodate both time zones, although everything will be available on demand if you cannot fit that into your schedule. We encourage you to register ASAP. It's complimentary for members, so very nice, I do say. And all the details can be found on the website. So if you have any questions, again, just email us at ask@lbma.org.uk. As you can see, there is also the London networking event, which sits inside that conference on the Monday evening. So when you do register, just indicate if you are interested in attending. We have a very large wait list, obviously due to COVID. We have a limited amount of numbers, so we'll be monitoring that very closely. And I think that's all from me for now. I won't return again until September, when you're all relaxed and rejuvenated after a couple of holidays. I hope you have a lovely time, and I can't wait to hear all about it when I get the opportunity to meet you at the conference reception this September. So if you do have any final questions, again, just head to our social media accounts or our website or email us. With that, thank you. Have a lovely summer and goodbye.